Let's have a good chat with Martin Crabb. He is CIO at Shaw & Partners. Hey, Martin, welcome.
Good to be here, Nadine.
It's been pretty positive today, hasn't it?
Yeah. Interesting looking at that daily chart, though. We didn't have that intraday volatility.
I saw that.
It's just a flat line from 11 o'clock. Now, that hasn't been the case. Normally, I come in here and it's wiggling all over the place because you've got data out of China or you've got some results that people don't like. But it was really, there's some really big moves in the market today. I mean, Temple and Webster in one direction, Challenger in another. Yet net, the market seemed to do all of its deciding in the first hour of trade and then just cruise through the day.
Well, let's get to some of the reports then. I'm really keen to get a view from Shaw & Partners about BHP. We had a chat with the CFO, David Lamont. Look, say that they've got some powder in the kitty, to pursue M&A, even if Oz Minerals board doesn't engage again. But it really wants to continue to invest for growth through the cycle. As an investor, does it make you cautious?
Yeah, look, Rio Tinto really surprised people by not paying out the dividend everyone thought they would. So there was a little bit of fear going into BHP's result that maybe that might be the case with them, but clearly they've decided that giving cash back to shareholders is a good idea, and hence the payout ratio in the 70s, down on last year, but still record second best ever profit result, and they've followed through with a higher than expected payout ratio. So it's been a bumpy year for cash flow out of BHP, because remember the BHP Petroleum demerger, you got a fully franked Woodside share, which is worth $5 or $6 a share. Now you're getting another $3.50 odd US of cash out of the company as well. Typically what you get at this point of the cycle is they all get excited, they're all making lots of money, and they embark on large scale M&A. And Oz Minerals feels a little bit like that. They could have bought this stock at $3 or $4 when no one was looking, not paying 30-ish, which is what they'll probably have to pay. So there's a little bit of, this is frothy top of the market behaviour, but obviously Oz Minerals is not substantial enough to derail BHP. So the market obviously voted with its feet today, or voted with its wallet. Stock was up 4 or 5% when I left the office. So for Australia's biggest company to surprise by 4 or 5%, it's a pretty good result.
Yeah, it is. And disciplined cost control, because they are talking about rising input costs, rising labour costs, talking about uncertainty in the short term in China, but stability, moving in there. But it was very cautious commentary coming from the CFO. In my view, wasn't talking up the global economy to any great extent, but really sort of emphasizing that they're going to stick to these mega trends, these future-facing commodities, and look to grow.
Yeah, and they're shifting from an old world commodity mix, being coal and iron ore, which pretty much goes into making steel and ergo into structures in China. China's obviously pivoting away from an overgeared development sector, into education and more tertiary industry. So BHP's left with an outdated portfolio. They need to update it, and that means more nickel, more potash, more copper, more future-facing commodities, as everyone calls them. The problem is BHP is so big, it's difficult to get a project big enough to turn the dial. There aren't that many massive copper discoveries. Nickel is not such a big market. So even if they do continue to grow, it's difficult seeing them complete a big step change. So it's more incrementalism. So they announced today the potential expansion of the West Australian iron ore, because obviously that's been pumping out the same number of tonnage for years now. But it's more incremental, good cash flow, good payout. As they said, disciplined cost control, because they're in the eye of the cost storm. There's a labour shortage, and there's wage pressure, and there's raw material pressure as well. So for them to be focusing on cost is the right thing at this point in the cycle too. Okay,
now let's just run through a few other results. Goodman Group, that was a darling through the pandemic period. Are we getting a sense just in the share price reaction to the company's results that maybe, I don't know, best days over?
Yeah, look, it's a super premium PE stock. I mean, if you look at it as a property trust, it's ridiculously overpriced. As a growth stock, it's probably okay. And the market oscillates between this is a property trust and it's a growth stock. So the good things about it is just continuing to guide higher growth outlook. They're now setting their targets on 6 to 11% EPS growth versus 6 to 9. So they think they could punch through that top end of that range. They've got the best portfolio, the best sites, and you can just see this thing grinding out double-digit EPS growth for years and years to come. So it's a stock you want to own. The question is, what price do you pay for it? And when the result comes out, everyone goes, that was a great result, but can they continue to do it year in, year out? So a lot of their profits are being driven by development, which the market has a bit of a problem with because it's just lumpy and it's more difficult to predict. So what capitalisation rate do you put on a development profit versus, you know, the rental income they're getting? So still a quality stock. We've got it in our core portfolio. We think most people should own this stock. It's pretty solid. Would you rush out and buy a lot of it today? Probably not, but I think it's a core holding.
Got it. Thank you. Okay, so you mentioned Temple & Webster, Life 360. We've talked BHP, SG Fleet. I mean, it was so tough to even keep up with all these results today, wasn't it? Sims Group was down by 3%, Seven West Media off by 4%, SCA Property down by 4%. We'll be speaking with the company tomorrow. SEK, we haven't devoted a lot of time to SEK. I mean, it used to be this tech darling, high growth company. Shares down by 5%. So what was not to like?
Yeah, look, I think costs are starting to become an issue for a lot of these companies. And, you know, we had car sales yesterday, we had SEK today. And look, the headline result was good. It's obviously a super tight labour market, Nadine. So, you know, candidates are in a lot of demand. You know, a company like SEK can charge more for people to find candidates and get the right candidates and put job ads in and so forth, because it is such a tight market, not just here but around the world. So it's a really good time to be in SEK's business. The issue is just that cost pressure coming through, and it's basically labour is probably the biggest part of it, but just more generally there's cost pressure in the industry. So are they in a strong enough position, and do they have enough pricing power to continue to increase their prices above and beyond their cost structure? And that was just a little bit of a concern on the call today. So the result was fine, wasn't a miss on the numbers, but it's just that, and we're getting this a lot in results, just this caution about the cost structure, because not everyone prices their wages on a daily basis, right? No one prices their, so wage negotiations and wage changes tend to come through in lumpy amounts. Like the banks have got enterprise bargaining agreements which roll over in the second half of the year, so they'll start to see higher costs from wages. So I think a lot of these companies are calling that out to investors and saying, look, things are okay at the moment, demand looks okay, we're just worried about costs going forward.
Okay, and Challenger, so a review of its banking unit, that was not good news. Also, profit drop, that's never good news, and punished accordingly. Knee-jerk reaction? I don't know.
Yeah,
down 10%?
It was a little bit of a train wreck for Challenger, unfortunately, today, because it wasn't just one or two things. It seemed like everything. So life sales, so sales of life insurance and annuity products were below expectations. Outflow from their funds business were $2.5 billion, not $1.5 billion. And the bank is continuing to bleed money and looks like it's going to continue to bleed money going forward. So there's a combination of things where you're kind of going, these guys are getting smashed on all fronts here. Do I really need to be here? So hence the pretty savage market reaction. I mean, 15% I think it was down. That seems like an overreaction, and we may see a little bit of a bounce in this tomorrow, but there was just so many things not to like and so many negative surprises, it might take Challenger a while to recover.
Okay, look, I'm just cautious of time, but can I squeeze something in on Shopping Centres Australasia, SCP, I'd rather say that, because we are speaking with the company tomorrow morning. What do we need to know? Because all of these little property groups that reported today, you know, all flagging rising interest rates. Yeah,
it looks the ability to pass on inflation-linked contracts. So a lot of retailers have got CPI-linked contracts, which means that if inflation's running at 6 or 7%, which it is in Australia, all of their tenants have to pop up an extra 6 or 7%. Now, for some companies that are getting price rises through, that's not going to be a problem because they're getting maybe 10 or 15% price rises, so they'll be able to suck that up. But again, retail's labour intensive, so if you've got wages going up by 5 or 6%, your rent's going up 5 or 6%, unless your sales are going up by that amount, you're going backwards. So it's pretty tough out there in retail. There's a lot of strips that are empty. There's a lot of shopping centres that are half empty. So I think it's tough for retailers. So I think passing on CPI-linked rents in the next 12 months is going to be really hard. So I'd be asking them, how confident are they? What are their vacancy rates at the moment? What are their lease expiries? So who's coming up for a renewal? And how confident are they that they can pass through CPI-linked increases?
Thanks. There's my cheat sheet for tomorrow morning. Looking forward to it. And just for something a little different, I don't know if you heard, but I was speaking with Sarah Hunter from KPMG about overseas arrivals and departures. We were talking about it in the context of migration because obviously employment is so front of mind. But is there anything in that data for investors? And I'm thinking of, you know, it's so so worn now, but like the reopening trade.
Yeah. Well, Qantas is the obvious stock they want to own, right? But the problem is they haven't got staff, right? So I saw on one news thing today that the Heathrow's got a passenger cap, so they're only letting so many people through the airport. But look, it's a V-shaped, or what's that? A U-shaped recovery. Remember those V's and W's that we talked about during COVID? Everyone except you and I are in Europe, basically. That's what that's telling us.
Oh, if only, Martin. Don't make me dream. Okay. So generally speaking, when you look at the market performance, the rally that we've been seeing over this past 7-8 weeks, justified in your view?
Yeah, look, part of it feels like a bear market rally, but I think something did change on the 16th of June. When the Fed went 75, that was such a game changer because it changed everything. It changed credit spreads, it changed mortgage rates, bond yields, equity markets, everything changed because they said, these guys are serious about controlling inflation. We don't need to worry about that anymore. So the inflation fear is going, and now it's, hey, this might be a soft landing. We need to reprice into equity. So look, we've bounced back very hard. We've gone from being undervalued to probably fairly valued. And so it all comes down to the fundamentals now. But I think the rally that we've had makes perfect sense to me and probably should continue as long as the earnings picture holds up, which so far, touch wood reporting season, it has. And obviously BHP's result today, the biggest stock in the Aussie market, and it's beaten by 5%. So that sets us quite nicely up.